All right, so welcome everyone to our information session. This session is something that I've wanted to do for a long time, and uh, basically as a part of this, and obviously I'm going to talk about the sort of business exit summit at the end, and that's something that obviously we've been talking about, we've been sort of sending communications about, and for me, like the more I think about what we've been able to do and this session and just all the different aspects that have taken place over the last few years, to me, this is now a really important time where founders need to start really thinking about their business in a completely different way. And so what I'm going to do is, obviously the session is titled, engineering a high valued exit and a premium capital raise. So to start the session, I'm actually going to give you a bit of my own journey, right, over the sort of since starting WI and then also over the last couple of years and why we're doing this now. And also as part of this session, as I go through some of the insights that I've learned from both investment bankers, deal makers, PE guys, founders, owners who have gone through exits, etc. The idea in doing this session is to provide you some high level, I suppose, thinking questions that you need to be sort of asking yourself and that I ask myself. And also, I suppose, to give you an opportunity to frame your business in a different way and also start thinking about what can happen in the future. And the reality is that whenever all these different articles you see about exits and founders and owners achieving their, I suppose, creating generational wealth for themselves, or selling what they've been pouring their hearts and souls into for it could be 2 years or it could be 20 years. The reality is there is some keys to basically how they actually do that. So for my journey, when I first started Wholesale Investor, I was very fortunate enough to come across a guy by the name of Tom McCaskill. Now, Tom was basically retired at the time. He was only pretty much doing speaking. And he created a series of books. And in those series of books, it was all focused around the engineering of a strategic exit. And he'd spent a lot of time in the US, and he'd spent a lot of time with the technology businesses in the US. And so what he did was he made it his mission to try and understand what was the difference between how companies achieve these sort of high valued exits and the companies that weren't able to do that. And the reality is, I suppose all of us, as owners and as founders, we get sold on this ideal that our business needs to be absolutely perfect for us to get a great outcome. And it's always the way that when you're going through this journey, and it's all by well-meaning people and they want to assist us and so forth. But of course, their job is to find the flaws in our business and to, basically then, engage us to have them solve those flaws and fix them and prepare us and all this sort of stuff. But the truth is, a successful exit, the foundations for it are actually put in years in place, years before the actual exit. And also they can be super important when it comes to a capital raise as well. So all the things that we will be covering, during this session are elements that you can be thinking about for your own business, and also that you can start implementing straight away. And it's not like, you flick a switch and then all of a sudden, you're a high value, you're a high valued sort of takeover target or a high value sort of asset to someone else, or a strong strategic investor potential. It's more about just starting that positioning process, starting thinking differently, and also start building the people around you that can ultimately help facilitate that transaction. And, this is what this game is. This game is a very relational business, but it's also a very strategic business as well. And the reality is the person who might be that strategic investor or that person that might be the acquirer of your business, they may not be in your ecosphere right now. But it's about how do we set ourselves up so that we do become in that world. So I'm going to be going through effectively, 3 components with tonight's session. The first one is what you'd expect from this type of session, talking about sort of just the clear operational side. Then I'll be talking about the strategic aspect. And this is the part that I find most interesting and can often break all the rules of what you would naturally think would be the result of a successful outcome. And then the third component is I'm going to be, talking about how you can actually start positioning yourself, what questions you need to be asking, etc., to basically start that process. And then after that, I'm going to be taking you through a bit of, high level, what we're going to be covering at the Business Exit Summit, who we've got coming along, and effectively why I think it's important for anyone on this session or anyone watching it to actually come and join us at the summit, because, we're only going to do this event once. To me, it's important for us, really one of the main drivers for us is to really start positioning ourselves in this sort of exit space, because I think it's a significant opportunity. But the second part is there's just so much incredible content creation potential from that, which we can then sort of work going forward. But the reality is, I said, for many of you, you never know what right idea or right introduction can ultimately make the difference in your successful exit. So, key things, I'll talk about my journey. As I said, Tom McCaskill was my really sort of starter influencer. And for day one, I've always thought about wholesale investor as a strategic asset. Many of you know, like every single time someone comes to me, they start talking to me about, oh, why don't you charge success fees? Why don't you do this? Why don't you do that? And the reality is, if you look at our space, we've been operating now for 16 years. And in 16 years, if you go and have a look at the ecosystem, there's really actually not a direct competitor to wholesale investor. So I always have that awkward question, like, who is your competition? And whilst people do elements of what we do, the reality is there isn't. And said that is because I've always thought our business strategically. And I'll take you through basically my own journey, and likewise I'll share plenty of examples throughout this session, right? And my hope is that it gives you ideas for yourself in that process. So the 2 years ago was really the thing that set in stone the foundation for us going down this direction. There was two things that happened simultaneously. The first one is I come across the man by the name of Jim Lowry. And now Jim Lowry is a director of Loop Australia, but he's also an ex-private equity guy. And, he had this conversation with me and he said, Steve, he goes, I want to talk to you about the greatest wealth transition that's about to take place. And as soon as he said that, I started thinking to myself, oh, naturally he's going to be talking about baby boomers, basically transferring their wealth to their kids. And he goes, no. He goes, what I'm talking about is the need for baby boomer business owners that are going to need to actually retire. And effectively, there's only a certain few ways that can happen when baby boomers are going to go through retirement. And that is, it's either going to be succession. And there's not a strong track record in successful successions, right? And so if they don't do that, then he's talking about, well, who's going to buy the businesses and how they're going to, basically how they're going to continue. And the actual truth is, right now, there is thousands of businesses just shutting down, right? And so when I thought about this, I think about our ecosystem. It's like, well, our question is always the same. How do we try and engineer, or how do we provide education? How do we provide content which can help people basically achieve the goals that they want in engineering their own business for that result? And as we all know, the innovation space is difficult. Building a business is difficult. But also going through an exit, it can be life-changing. And the reality is sometimes we talk about the value of our businesses and what we're doing and so forth, but we don't actually understand the true value of it from the eyes of a potential buyer. So that's what I really hope to cover tonight. And then the second thing that happened was I was fortunate enough to have a great conversation with Cameron Blanks from PEP, where he was talking about how the private market is going to grow to a $30 trillion market. And that was important for me because for a long time when I was in this space, I'd always thought about the ultimate exit for every founder is going through an IPO. But the truth is now we all have so many more options available to us in going through that process. So, they're going to be some of the things I'm going to be covering tonight. So I hope you all enjoy the session. And then, as I mentioned, I'm going to be talking about the Business Exit Summit, and I've got a ridiculous special offer for everyone at the end of it. For those who would like to come along and would like to really sort of do a bit more of a deep dive into how they can start positioning themselves for either that premium capital raise or a high value exit. So I'll get into the session. So effectively, if you got to think about your business, there's effectively going to be three states of value for your business. The first one is operational excellence. And this is the one that's sort of the textbook, of what we get taught to us. And I will go through those 7 pillars about what operational excellence look like for a potential buyer. Now, operational excellence really, is very important if someone is focused on being acquired by a financial buyer. So a financial buyer is typically, someone is looking, actually, I'll go through it in more detail later. Second one is strategic potential. So what value does your business have to a potential acquirer? And then how can they create additional value from that? And the third one is ultimately where we all want to get to, which is where we get absolute maximum value for our business. And it's effectively the combination of that operational excellence and also that strategic potential. So the first one is the financial sale. And as I said, this is what most people are guided towards. This is what most advice is sort of given around. It's really about those 7 pillars that I'm going to cover shortly. But basically about building a profit stream, building a profitable business that has scalability, that has predictability, which is the most important part. And effectively, the person that's buying it, they are looking to buy it for its pure profit stream, right? So that's the first one, is the financial sale. And then we get into the key, right? The key is the value through potential. And that is in the strategic sale. And the strategic sale means that, it's defined by when someone's looking to acquire your business because of something that is unique about it. And that could be, you could have unique IP, or you could have a unique product that they want to acquire, which we've seen over and over again. Or you could have unique data that sits under your business, right? And once again, these are things that you can be thinking about for a capital raise as well as for an exit. But I can assure you, if you start thinking about them now for your capital raise, it's ultimately what's going to help you in your value in moving towards an exit. Market access, for a good example of that is there's various different kinds of market access that buyers could be looking for. It could be geographical access, it could be industry access, etc. Or it just could be it just could be simply the disruptive potential of your business to their existing business. So that's why they would look to acquire you. Brand positioning could be another reason that someone could see a value in a strategic sale. And then also distribution and ecosystem, right? And this is becoming, all these 6 elements are key elements that you could actually start thinking about today, about what is truly unique about your business. Now, it's one of those things where people say, oh, what's the differentiator for you? And they'll say, oh, we give great customer service. Well, that's just, in these days, that's just not going to be enough going forward, right? And you really need to understand that, because I said it becomes important for how you start building the foundations for your own business. So the ultimate, effectively how you sort of think about the ultimate state is the Citadel, which is the ultimate strategic asset, where it's the combination of, you've got very strong, a very strong operational business, right, where it's financially performing and the foundations are set. And as I said, I'll cover those 7 pillars in a second. And also you've got a compelling narrative around the strategic opportunities that a potential buyer could unlock with your business. Now, of course, I'm always highlighting the most important thing for tonight is that when you're thinking about your own business, obviously we think about it from our own perspective. What's most important about tonight is stepping into a potential buyer of your business and helping them understand the value that they're looking for, whether it be a financial buyer or a strategic buyer. So the next stage, so the blueprint, it pretty much has 2 parts, right? One is the 7 pillars of operational excellence, right? And that's something you can work towards as you're actually going through the building of your business. Or if you're thinking about an exit in the next 12 months or even in the next sort of few years to sort of aspire to keep on sort of driving towards. And then the second part, which is the most important, or sorry, not most important, but which is super important or sort of fundamental, is that sort of building that strategic narrative about what could it potentially be, right? So your fortress, the 7 pillars, the first pillar is the financial fortitude of the business. So, what are the finances behind the business? What is the actual profit? How is the business performing, etc. That's going to be the first element that a potential buyer is going to be looking at. And I'll go through what questions they're going to be thinking about, as I go through this. The second one is, what is the growth potential of the business, right? Because effectively, if someone's going to be buying something, yes, it's great, you may have a profit stream, but is there also growth potential in your industry, in your vertical, that they can potentially exploit or continue building on, as far as where you've got to today? The third one is the independence narrative. And this has 2 layers. The first layer is, if it's a pure financial sale, this is fundamental, right? Because it's trying to understand is, can the business be independent of you as the founder, or are you absolutely tied into it, right? Now, in a strategic sale, that could be a different story. The next one is customer diversification. There's a great story I was provided. I'm part of a group called Vistage, where it's a bunch of executives. We get together once a month. And there was a great story by a sales leader, and he was basically talking to one of his customers. And, he was going through the business, and he asked him about his business performance. Business was performing well. And he said, well, now tell me about your customers. And he goes, we've got one customer. And he asked him, do you see an issue there? And he said, obviously, yes. Now, sadly for this person is that they weren't able to secure any other additional customers in time. They lost that big contract, and that contract was with a sort of big corporate. And then effectively with that, they lost their business, right? So the customer diversification is part, and I'll give you some benchmarks to think about, as part of this session. The third one is the systems and scalability, right? So if you're going to look at your systems, how scalable are they? And there's some simple frameworks that you can actually look at to think about, that an investor is going to be thinking about, or a buyer is going to be thinking about when they come in to acquire your business, because that's going to impact the price that they're going to pay for your company. So systems and scalability. Next one is your competitive moat, right? And once again, I'll give you some framework questions that you can ask yourself around, or that a buyer is going to be asking about for themselves, about how really different is your moat. For my one, for example, obviously we're quite unique in that we're a 3-sided marketplace. The truth is, it's incredibly hard to build a 3-sided marketplace. So for us, we have business owners and founders on one side, we have investors on another side, and then the third side is the actual industry itself. So all the different professional services that sort of operate in our space. We're super fortunate to have all 3. It's not like that part for me wasn't by design. The truth is, I always knew my investor database would be high value. The reality is, now I realize that all 3 sides of my ecosystem are high value, right? So the second part is my distribution is, now that we've got sort of 45,000 in our ecosystem, we know that to try and replace that is incredibly hard. And someone would have to spend a lot of money and a lot of time and a lot of energy. In fact, for me, it's been 16 years of, absolute grind and relentless persistence in actually doing that. So competitive moat is super important. And then an exit ready team, right? And this, once again, I'll give you some framework around that. Now, there's 2 layers to this exit ready team. There's your internal team, and then there's also the people that you have around you as well when you're actually going through this process. So, I recommend to take a bit of a screenshot, of this, because effectively they're the 7 pillars that you want to be thinking about. It's just it's one of those things where you can just have a simple slide, or a simple, image up in front of yourself to remind you about the things that you can chip away at on a daily basis, right? Because effectively, I said there is going to, and as I said, I will add the question frameworks that they're likely to be asking when they're going through this. So what we'll do now, and as I mentioned, we're about to try and understand the high level first thoughts, that a potential buyer is going to be looking at. Now, obviously there's various layers to all those different questions they're asking, but These are the questions that you need to be asking yourself, when you're going through this process, because the buyer is going to be asking it. They are going to have an internal scorecard before making an offer, right, on your business. Because what they're effectively trying to do is they're trying to build a risk profile around the acquisition of your business, right? And basically for you, creating value means eliminating those risks or minimizing those risks for them. Destroying value means allowing those risks to continue, right? So let's go on. First one is I'll talk about the customer and revenue risk. So a simple framework to think about and ask yourself is, do any of your customers represent more than 15% of your revenue? Right? That is one of the first questions that you may want to be asking yourself. Because, for a potential buyer, if you lose that customer, they could be potentially losing 15% of their revenue, right? The second question that they're going to be asking themselves is, if that is the case, or if there's any high value clients, right? Are there key relationships contractually or dependent on you personally as a founder, right? Because if this is just a purely financial buy, right, their concern is that if you leave as a founder, what revenue goes with you, right? So understanding that they're going to be the first things that they're going to be having a scorecard on. Because if they, for example, if they identify that 40% of the revenue is tied to you because of one big customer and sort of key personal relationships that you have, that's going to represent a risk to them. And then the last one is market dependence, as far as how exposed are you to a signal segment, a market segment, or a specific geography that could be representing a risk, right? So for example, if you were exporting a whole bunch of things to places like Ukraine and Russia, that was going to cause an issue for you over the last sort of 3 years. I dealt with a company that was raising capital. And by the way, all this stuff is just as relevant, as I said, for a capital raise, as well as what it is for a strategic exit. Right now, of course, we get roped into other metrics that people are sort of looking at and how they're positioning and all that sort of stuff. But just know these are also fundamental questions behind the scenes that the analyst that's likely, and by the way, when you go through this process, you're going to be dealing with some analyst that's going to be going through this sort of checklist and this scorecard. So one example I had was that I was dealing with a company during COVID. And this company provided an online platform for people to have amazing and wedding experiences in Asia. And as part of that experience, they were, because there's certain groups where what they look to do is they look to book exotic destinations in Asia for their wedding, and then they have their entire families and friends and so forth, and they book out hotels and they do. So they were facilitating this all online, right? Now, of course, when COVID comes, their entire business is decimated, right? And you can't pivot that sort of stuff to online, right? We also had a similar issue where, when we couldn't do in-person events, we had to instantly pivot to online, right? The interesting thing about that for our business was that previously represented a risk, right? Even though it wasn't really quantified, like people saw us just as an events business. So it previously represented a risk. When we positioned everything to online, right, then all of a sudden it had people thinking of us in a slightly different way. Also, we doubled down on building of software as well as part of it. So as I said, for a long time, I've been sort of chipping away at building these strategic layers of opportunity with our business, right? Understanding that key aspect that I highlighted. So that's the customer and revenue risk aspect. Then you move over to the operational and also the asset risk. So the first one on the founder side, and I know this is a sort of common cliche thing, but can you leave the business for 3 months and then come back to something other than a car park? Right? That's an obvious question. Once again, this is focused on if you're going down a pure financial sale, right? Systems and scalability. It's a great question to ask yourself. If your business was to grow 50% over the next sort of 2 to 3 years, how does that impact the business? Do your current systems break, right? Does it break your team? Does it break your system? Does it break the cash flow of the business, etc.? Right? Working capital efficiency, competitive moat. Now, this one's a really important one. And the simple question that sort of sits behind that is, what is to stop a well-funded competitor coming in and copying what you're doing? So if you think about it from a really crude level, what's to stop a company coming into your area? And this is why, companies that are building software, which could potentially be sort of done by Google or Microsoft or so forth, the first thing that, often companies will get a lot of rejection because they sit there and go, well, Google's likely to do that, or Microsoft is likely to do that, or Amazon is likely to do that, right? Because they're saying to themselves, well, if a truly well-funded competitor comes in, what does that do to your business? Or if a well-funded competitor comes in and then starts offering, your existing team members, 20 and 30% higher salaries than what you are to take them away, then where does that leave you? Why are your customers actually still dealing with you if that was a scenario? So, and then the last one is team retention. So the team retention part that I was sort of referring to is that what is the incentives inside your business to keep top talent for at least 3 years post the acquisition, right? So why is that? Why will the internal IP stay with you after an acquisition is done, right? Or stay with the company? So it's making sure, and the reason why they're asking that for themselves is because if they buy a business and then and one of the key aspects is in that internal IP that sits inside the company, what risk does that present to them and their future revenue? Now, the truth is, AI is really changing the game on that, right? Because even so, there's still obviously key team members that make companies, operationally better, right? But AI is making a significant difference. And over the next 2 to 3 years, it will continue to get better and better through the combination of enterprise AI, AI agents, etc. Those factors are, going to be, not, I suppose minimized or continue to reduce, but that team retention part is something that they want to understand, right? So this is where it gets really interesting, is the forging of your key and the forging of your strategic narrative. So the fortress gets you the great price. The key gets you your strategic premium. And more than that, it's, as I said to you, I'll have every day I speak with founders and every day they tell me about what they're raising at, what valuation, etc. Sometimes they don't understand these strategic aspects to what they're building and why it's valuable. Like if someone was to ask them why you value it like that, they actually typically can't answer it, right? It's because this is what they feel. There's factors which, there's not even typically science to it. It's often art, how people think about valuations, or just sometimes it's just really made up. I've seen it with companies where they change their valuation because they feel like they feel they're getting bullish on the investor momentum, right? But this is important for you to sit there and understand what the true value of what you're building is, right? And what that strategic premium can be. So in understanding the difference, a financial buyer, the question they are asking themselves is, what is the profit stream I am purchasing? And what are the risks associated with that profit stream? Their goal is to actually operate the business as a standalone entity for its operational cash flow, right? That is how they are thinking about the purchase of your business. Now, of course, they may be thinking about, attaching it to other businesses that they have. They may think about rolling up other companies in your sector. But ultimately, the most important thing for them is they need to know what that profit stream is, right? And so your value proposition that you're selling to them is that this is a de-risked profit stream, right? That's ultimately what you want, to get a great price to a financial buyer. You want to be selling them the most de-risked profit stream that you possibly can, that also has potential growth upside as well, right? On the strategic side, it's a very different question. On the strategic side, the strategic buyer is asking themselves is, what can we create with the asset or assets of this business, right? And so their goal is also slightly different. Their goal is about how can they incorporate you or integrate you into their business and then unlock new revenue, new growth, new value opportunity, and also synergies as well. That could mean sort of cost reductions, right? So they could not only sort of improve the profit, but also absolutely unlock new layers of growth. Or it could be aligned, with or how does this align with their 5-year vision or 10-year vision about what they're building for their business, right? So what you are selling is effectively a unique asset that unlocks potential for them. And as I said, you see this every single day in business. And as I said, you sometimes don't, like if you were to, there's actually one of the guys we've got speaking, he always talks about the sort of, he calls himself a deal nerd, right? And he actually goes and assesses all this stuff. The interesting thing when you really boil it down, there's some factors, there's some questions that the strategic buyer is asking themselves that's very, very different to the financial buyer. So on the next slide, I'm going to talk about what the financial exits are driven by. And then after that, I'm going to talk about what the strategic exits are driven by. So financial exits, they are driven by EBIT multiples, right? So profit multiple, EBIT multiples, where they're thinking to themselves, how much is the business earning, right? What is the EBIT of the business? And what multiple am I willing to apply to it? And that varies on every different sector, right? In their mind, they're doing their best to purchase a profit stream and de-risk that profit stream that they're buying, but also understand what potential upside there is in purchasing that profit stream as well. Like what additional growth can be extracted from it. So what that means is that your focus as a founder is on consistently building that EBIT, right? Because the more you build that, the more you build your earnings, the higher the value you're going to get as you go through a sale, right? So it's a very simple principle, but it's important to understand it at a really high level. Now, this can vary based on market conditions. So, and how you can understand that is if you were to sell your business in 2020 and 2021, financial exits, you could have been getting very appealing multiples, at that time. If you were selling in, late 2022 and 2023 and probably even early 2024, once again, you could be getting a very different multiple just because where are things at. And once again, even the financial buyers, they've got a story to tell their shareholders. And also they've got to get access to capital. And there's a cost which is going to get, for the purchase of your company, there's a cost of that capital that they have to factor in, right? So, these are the aspects that are driven, that are sort of thought about in the financial exits. A strategic exit is basically driven by other factors. Basically, they're investing in how they can leverage their infrastructure to build future profit streams from your IP or from your unique asset that they have identified that is relevant for them, whether it be your unique positioning, your unique brand, whether it be unique IP, your unique product, your distribution, etc. What they are thinking about is how they can build future income streams from that. Now, the most humbling part about this is the fundamental thing that they are thinking when they buy your business is that, and this is from the buyer side, they have the belief that they have the ability to exploit your assets better than you, right? So as hard as you've worked, as passionate as you are, as a team you built around you, capital you've raised, everything you're doing, their fundamental belief is that they can actually exploit what you have built far better than you. Why? Because they've basically got a bigger balance sheet, potentially. They've got greater networks than what you do. They've got greater internal capabilities, right? They've got greater distribution channels than what you have. Or they could have different more customers that they can sell your products into. Or the other way is that they can generate more customers that they can then introduce them to their products, right? So if you want to understand what fundamentally drives things like the purchases from Salesforce and Oracle, etc., it's their fundamental belief that they can buy a company, and then sell their products to their customers. Or in the Microsoft case, they typically bundle them together, making their own offer more valuable for their sort of enterprise customers, etc. Right? Whatever it is, you want to be thinking about what is it, how is it that they could exploit what I have got better than me, right? And then the last one, it's not talked about too much, right, in sort of day to day, but it's fundamentally there. And for the listed companies, what's really interesting is that when you move into the listed environment, typically companies are trading at especially the bigger company, they're trading at a higher multiple, right? So for example, if you look at someone like Google, right, they're trading at a certain earnings multiple, right? So often what listed companies do is they want to acquire private companies because in the private company space, there can be an expectation that they can buy your business for a lower multiple than what they're trading at as a listed company. And effectively, this is what they look at as far as it's called an EBIT multiple arbitrage, right? So there's an arbitrage in the value that you're trading at as a private company, and they're trading at as a listed company. And if you've ever seen the examples of when companies do roll-ups, so for example, there's a great example with Glencross, which is a roll-up of veterinary practices. Now, if you think about it, if you go out to a regional veterinary practice, and if there's someone looking to sell their one veterinary practice, what is that worth? Typically, it'd be owner driven. You basically get a very, very low multiple for it, right? Because there'd be relationships, it'd be sort of local people, etc. What they did was they basically rolled up a group of veterinary practices. They made sure they gave shares to they included shares, and I can't remember if it was a part cash as well, to the owners of those veterinary practices. And so how valuable is one veterinary practice compared to 100? The revenue streams are diversified. The risk is, basically minimalized. If one sort of has an issue, that's not much of a challenge. Effectively, they can drive it as a group. They have better bargaining power. They have better operational capacity. And also, when they go into that listed environment, they've got a great ability to raise capital to go and buy more, to continue to strengthen that revenue flow. Now, in the example, I'll give you an example. Like, for example, that listed company could be trading at 10 times earnings. They may be looking to buy companies at 2 times earnings. So if that business, let's say it's a $1 billion company, and they've got $100 million of earnings, and they want to buy your business, which could have 10 million of earnings, if they can buy your business for 20 or $30 million, and then effectively go and add that $10 million onto their next earnings, onto their next earnings statement, what does that do to the potential value of their business? It obviously increases it, right? That's why they do these acquisitions, because over time, it starts to just, accumulate, and that multiple goes back to where the sort of expected sort of industry is and what analysts sort of place on it, etc. But that's why they do it. They're doing it because they can get a 5 in this scenario. They could get a 3 to 5 times multiple arbitrage on the acquisition of your business, right? So really interesting how they do these deals. Now, where are strategic exits commonly seen? Life science. Most deals in fact, most life science and medical device companies I see, they are building themselves to be strategically acquired. Right, so there's typically top medical device and top pharma companies that effectively acquire the sort of next companies coming up, and it's a very, very common pathway. Biotech this is pretty much the model for biotech, where effectively companies are trying to get themselves to the various stages of clinical trial, right? Where once they achieve once they get to a certain stage of their clinical trials, they become acquisition targets because they've effectively de-risked. They've de-risked the business, or they've de-risked the IP that sits inside the business. And I've heard crazy stories of, there's an Australian life science company that had effectively run out of money, was struggling to raise capital, And then next minute, I saw them acquired for over $500 million, right? And the reason is because a big pharma can do that is because they can acquire that company, continue to the end of the trials, and then basically have products going to market through their distribution, etc. So that's what happens in life science. Software and technology, I'm going to give plenty of examples of those, so I won't spend too much time on that, but this is where it all is. You know, they're continuously, Xero just made a big acquisition in the US because they want to get more US customers. Obviously, a lot of their customer base is around, you know, they dominate Australia and New Zealand, right? So they made a big move because they could access, they've got the share capital to do it, and they've got the balance sheet to go and acquire, or they've got the ability to raise capital to then go and acquire a company in the US to basically move there. That was their motivation. Then marketplaces, very, very commonly seen. You know, if you look at media, for example, you know, a lot of the most successful, you know, a lot of the most successful investments from, even though newspapers and TV and so forth is dying, their acquisitions have actually propped them up significantly. One of the funniest stories ever was one of the first investors into Google was actually Yahoo. Yahoo made more money from their investments, you know, in Google, and I think the other one was Alibaba, than what they did from their own business. You know, so that's why they typically do these types of acquisitions. Resources is another area, right? Very, very commonly seen. You know, you have the sort of resources companies, they will develop an asset, they'll develop the sort of JORC reports, they'll keep on getting their sort of drilling results until the point where it's substantive enough that a larger mining company will want to acquire them, right? And then telco has been one of the biggest areas you've seen. Like, it's happened over and over and over again, you know, as far as telco companies either being strategic investors or, you know, acquiring other, you know, telco operators. And there's various motivations as to why they do that. So now what we'll do is we'll go through the strategic buyer's internal scorecard. So these are the questions that you need to be answering, or sorry, that you need to be answering and thinking about from a buyer's perspective. So the synergy question. So if a strategic buyer is looking to buy your business, the first question they're going to be asking themselves is how much revenue and value can we unlock in the first 24 months? It's a great simple framework for you to think about. If you're either raising capital or if you're going through a strategic, you know, if you're thinking about a strategic exit yourself, you want to be thinking to yourself from the lens of the buyer, if they're going to acquire my business today, how can they achieve the most quantifiable value in the next 24 months? Second question, the next one they're going to be asking themselves, once they've looked at your business, the next question they're going to ask themselves is, should I build our own or should I just buy this company? You know, I'm going to use the example of Made Comfy, right? So Made Comfy recently got acquired for just over 50 million, and it got acquired by Oyo. So Made Comfy is a retail management platform for Airbnbs, and also they, you know, help sort of place people in Airbnbs as well, right? Where they've got their own marketplace. Now, of course, Oyo can't go and acquire, you know, Airbnb. However, they wanted to get regional access into Australia. So they would have been an analyst in their company that would have asked themselves, how much would we have to spend to achieve what Made Comfy have, and what would have been the risks associated with that? You know, because they think about how much money they would have had to spend on team, marketing, you know, trying to get penetration, brand awareness, etc., you know, to do it, and then how long would it take, right? So ultimately they decided that it's much better us just to buy Made Comfy and continue growing it, right? So, you know, interesting, said, simple thesis, but it's just something that we all need to think about, that's what our potential buyer, or even sometimes, just so you know, the reason why I'm mentioning about capital raising so often is sometimes what buyers do is they will do a strategic investment in a company, and if the company performs, they will look to do 100% acquisition. A beautiful example of this is a company called Quantium. Now, you know, Tim Trumper, who's on our advisory board, he was also on the board of Quantium. Woolworths very early on took a stake in Quantium. Quantium is a big data company. You know, they've got a great track record of being able to get access to de-identified data from credit card transactions. And then with that, they can build incredible profiles for customers for business. Now, what happened was Woolworths started out as a customer, right? And so they wanted to understand their customers to provide them with the right deals and all that sort of stuff. Then they became an investor. I think it was for 20%. And then now they're an 80% shareholder, right? So your customers right now could be your ultimate acquirers in your business. The next one is the integration question, as far as what is the true cost and timeline to integrate, their business or integrate your business into theirs. Now, this market power question, this is what you're seeing right now with AI. The biggest question that all the big players in AI are asking themselves is, if we acquire this business, does this move weaken our competition and strengthen our long-term defensive moat? This is why there has been so much money thrown about by the combination of OpenAI, Google, Anthropic, XAI, etc., to acquire companies as they try and grab this space. And you can see that's exactly what happened with Amazon, Meta, Google, Microsoft, etc. As companies would rise, they would simply acquire them, right? Because everything they're trying to do is to continue their market power and to continue to create long-term defensive moats for themselves. And then the narrative question is important, because when they do these acquisitions, got to remember, all the potential buyers of your business, they will also have shareholders, right? And so the question that they have to answer is how do they sell this to their shareholders? How do they justify the premium that they have paid in acquiring your business, right? So once again, important checklist to have for yourself, to be thinking about it from the frame of, when someone's looking to buy your business or even be an investor in your business. And then the last question is what is the multiple arbitrage that we could get in buying this business? So like what I mentioned, effectively, if they're going to, and companies sometimes, they actually state this in their announcements to the ASX about why they're looking to acquire certain types of businesses and the certain businesses that they'll be acquiring, because they're effectively going for that EBIT multiple arbitrage. As I mentioned, if your business is trading at 2 to 3 times earnings and they're trading at 10 times earnings, they get an instant uplift, right? So when I say they get a perceived instant uplift from the moment they acquire your business, right? So now, deal structures. So the other important part for us to think about as owners is if we are going to go through this part of an exit, and by the way, this is also done in capital raising, right? So the deal structure in media, for example, a lot of the media groups have done a lot of what's called brand capital deals. So for example, Airtasker, Seven West was a big investor early on in Airtasker. And the way they did that was a combination of cash and brand, right? Brand marketing. So what they did was Channel 7 run tons of ads. They, basically they allocated them certain millions of dollars worth of ad credits, as well as they were buying them, as well as they gave them cash. OpenAI and Microsoft, right? So Microsoft gave them cash, but they also gave them compute, right? So these are how deals are structured, is also very interesting. Now, obviously, Microsoft have got themselves very, very quickly to a 49% shareholder in OpenAI. So the 3 different types of deal structures, it could be all cash, the dream scenario for all founders, get all cash. Basically, money's in your bank, and you basically experience for yourself a life-changing exit, and effectively you get to feel that feeling of what you've been building, what you've been striving for, sitting in your bank account. The second way is part cash and part shares. So if it's a listed company, for example, they may do a deal where they pay, for example, 25% cash. So if they're buying your business for 10 million or 20 million, they may buy, for example, they may say, in this deal, we're going to do 25% cash. So they give you $5 million of cash if it's a $20 million deal. And they give you 75% of that value in shares. So they have to issue new shares, which go to that acquisition. And what that means is your shareholding, whilst you get, $5 million in cash to be distributed amongst your shareholders, you're also getting shares in that business. Now, why is that? Why could that be interesting for you? Because you could have belief in the long-term value of that company, and you could have the belief that your shares are going to grow because of their acquisition of your business. Your shares are going to be able to substantially grow in value as well. So, not only are they sold on the strategic value of your business, but you could also be sold on it and think that there's a greater upside for you in joining this bigger company. Now, in the US, this happens also, right? Because they have such a high volume liquid market, you'll see that a lot of the deals that get done by the likes of Google, by the likes of Meta, by the likes of Microsoft, etc., often they can do all shares deals, right? Because the founders know that they can pretty much sell their shares at any time, or depending on what sort of the ultimate deal gets done, they could be escrowed for a period of 3 months or 6 months or whatever. But ultimately, they know that they can sell their shares at any time, right? So they can realize that value of their cash, and they're not concerned about the value of their shares going to zero. Now, this can also be a risk. If you think about the height of the dot-com boom, there was a great example of how Mark Cuban made his money. He got bought by, I can't remember which company it was, but his company that he built got acquired, and then he did it as an all share deal. And then what he did to protect himself is he bought, put options against that company just in case it went to zero, so that he would make sure that he made money no matter what. Absolute genius strategy. But in the case of YouTube got acquired by Google for all shares, and they got acquired for $1.6 billion. Imagine what that value would be worth right now when you think about how much cash gets pumped out from YouTube and the value of what Google is now. And I think that was done in like 2006. So if you go and have a look at what Google's share price was in 2006, and you look at what it's now, you can get an idea as to why some people choose all shares. Instagram was done at all shares. You go have a look at the value of Meta in 2013 compared to what it is now. Two different worlds, right? So that is why some people do an all shares deal, is because they see that long-term value of the business that's actually acquiring them. All right, so here's some examples of deals just to sort of whet the appetite and sort of give you an idea of, basically, as I mentioned about the Google one, what's important to note is that was, basically Google's main revenue machine actually come from an acquisition. So AdWords was one of the first acquisitions that Google made, and because they saw that as a way to monetize their search engine. Facebook buying Instagram for $1 billion was one of 91 acquisitions that they've made. WiseTech Global is probably one of the best ones from an Australian example, because they've got such a diligent process into how they assess companies which they're looking to acquire, where they've actually templated it. They've templated their process, they've templated the metrics that they're looking to see for companies that they're looking to acquire that can expand their market potential and their market stronghold. DataSite buying Enserata, I've got to update this number. So this was one of my favorite ones because Sam's a good friend of mine. He's been a mentor for me. And I tell you, as far as one of the great human beings that I've come across in this space, it would be Sam. What was really interesting about the Enserata deal is Enserata was trading somewhere between 100 million to 130 million. And he sold that company for all cash for $236 million. Right. And that's just it's such a great outcome for an Australian success story in the technology space. Right. So that's a really good example of, not only, and funny enough, that company was a private equity backed company that bought them, but obviously they were very well capitalized. So they bought Enserata for $236 million. Block acquiring Afterpay, $39 billion. Right. Timed it perfectly. End of 2021. Early 2022, absolute perfect timing. Oracle and Aconex. So interesting with this one is Oracle acquired Aconex because they wanted access to the vertical dominance in cloud-based construction companies, right? So that's another reason why companies will acquire. And then Oyo acquiring May Comfy, that was completely focused around getting regional access to Australia. So your potential acquirer, your potential strategic investor, you may not know this, but there could be a company in the UK, a company in Singapore, a company in the US thinking about making market entry into Australia, and you sit there as the prime target for them to actually do that. All right, so those are some examples. I hope that gives you some insights into the strategic, into the way strategic buyers think about, when they're going to acquire businesses, and gives you a simple framework into how to think about this. Now, I will send the slides through to everyone. And so my hope is that we're all going to say, whether you're looking to do something right now as far as from a sale period, or you're looking to start building that strategic value, whether it be for a capital raise or for an exit, they're just some high level things for you to think about as you're chipping away at building your business. So now I'm going to just give you a bit of an introduction to the Business Exit Summit. So we're going to be hosting this shortly. Now, effectively, we've basically we've put together an incredible amount of speakers, right? So effectively across 2 days, if you think about it like this, we've got founders that have actually gone through 8 and 9 figure exits. There's just, I don't know any other time where people have put these kind of people in the room that you can get access to, where you can sort of talk about your own business, get your own insights from them, and effectively specifically around this area, right? So you've got founders that have gone through 8 and 9 figure exits. You've got advisors that where they do this every single day, where they're helping companies, strategically position themselves and also go set themselves up to go through an exit. And then likewise, you've got investors that do nothing but focus on investing into companies which are either going through exit or setting themselves up to actually go through an exit. So, pretty much we've stacked the room with people who can actually make a difference. And effectively, we've also structured the agenda where you can look at these two options of, being the fortress builder, where he's getting the business operationally right. And then the last one is that building that strategic key for your own business so you can actually create that higher layer of value, which a potential buyer or a potential investor is looking to invest into in your business. And so we cover all the elements around, whether it be deal structuring, negotiation, crafting the narrative. And as I said, you could be doing this for right now or for the next sort of 12 to 24 months, or you could be starting to just lay these foundations for the next few years as you grow your business. Sam, there's no one in the country that has seen more deals than Sam. In fact, Sam invested into AI going back to 2019 because they wanted to understand what a successful outcome looks like in the M&A and in the capital raising space. And they wanted to understand what the process, what the transaction looks like in the lead up. Right, so they invest into AI very early. No one has more insights into M&A transactions in this country than what Sam does. And obviously he used those insights to sell his own business, right? And also attract investors, etc. Raj is incredible. He's become a good friend of mine, a good sort of advisor, and just like he's invested into 40 companies that have gone through their own exits. So as far as an investor that backs companies that are looking to go through that sort of scale and exit, whether it be an IPO or sort of strategic acquisition, so that's what he focuses on. He looks for companies that, that are basically looking to do that. And he's one of the leading VCs sort of in the country. Dr. Craig West said he's worked with over 700 business owners that have actually gone through an exit. There's nothing he hasn't seen in this space. He's been in this space for over 15, 16 years. So he knows for all sort of, whether it be traditional businesses, etc., going through this process, said this is exactly what he does all day long. Pete Seligman, he's built 5 search funds. So 5 search funds are when they raise capital to go and acquire a business, right? Because it's an type of asset that they're looking for. And he's had 2 exits with that as well. He's built the largest community of what's called ETA investors, right? Or investors seeking ETA opportunities. So that's called entrepreneurship through acquisition. So he's built the largest network in Australia and New Zealand of investors that are looking to buy businesses to basically become entrepreneurs, right? Lisa Merriweather, you would know all these names. Well, she was the M&A lawyer behind the scenes working with Arnold Bloch Lever on these transactions as a lawyer. And, speaking with Lisa as someone who knows both the commercial aspects of doing a deal and also the legal aspects, incredibly well placed to sort of give guidance and, sort of help people in their actual journey. But as I said, she's worked with some of the top groups in that process. And then Sean, I was fortunate enough to be a small shareholder in the Pi Lab Capital Fund, which did incredibly well. These guys have seen 5 of their companies, I think, go through exits. And also now they've built their next fund, which is around the forever acquisition model. So when you're trying to understand who are the potential buyers for businesses, they've built a model where basically they acquire businesses and they never sell, right? They just basically keep on aggregating companies that they purchase. And this is what they're doing now with their Pi Lab Council Capital Fund, where they're basically just acquiring businesses and they aggregate the total revenue. There's a beautiful example of that in Canada called Constellation Software, where all they do is just buy profitable companies, and then it's now worth $30 billion. So that's what they're doing at PiLab Capital. So the expertise that we're bringing across the 2 days, it's effectively you got insights from over 27,000 M&A and capital related transactions, decades of experience from the different panelists and people who are involved, seeing over 1,000 different exits, over 60 portfolio company exits from the investor side, and obviously insights from the deal makers behind the scenes, whether they be the investment bankers, whether they be the lawyers, etc., that have helped facilitate these transactions, and these exits. And then the most important one is the founders that have actually done it, the people that are in your spot that are actually thinking about, that have actually gone through an 8 and 9 figure exits themselves. We're bringing them directly to you to actually spend time with. So, we're very fortunate that this has obviously been my network that I built up over 15 years. And the thing I like to highlight is the amount of effort that it takes to get this kind of person in one room, you have no idea how hard. And also to have the actual exchanges there. So we've got the Australian Stock Exchange there and the Toronto Stock Exchange there, so you can actually ask questions to about it. And I'm also working on someone that's focused on listing, on helping companies list in the NASDAQ as well. So 2 days, deep dive sessions, one-to-one access, case studies, that you can learn from. And then obviously the outcome is that you build your own sort of blueprint for yourself, whether it be the creation of value or going through your own sort of strategic exit. So I've got an exclusive offer, for everyone today. And as I mentioned that, we're doing our best to put you in front of the people that are actually funding this, that are actually doing the deals, that are involved day to day, and that, could potentially be a significant match for what you're looking to do, right? So, as I said, all the elements we've thought of, and we're doing it to bring it together across 2 days on September 9th and 10th. As I mentioned, we will not be doing this again. It's a monumental effort from our side to bring this together. We've got an exclusive Roadshow offer. The normal ticket price is $1,950, right? But for tonight, effectively, you get to save $500 on your ticket. So if there's just one of you coming, you can save $500 on your ticket. If you're going to bring a partner, you can actually save $1,000. In fact, you can actually basically get 2 tickets for the price of 1 normally. Best of all, for everyone that comes on board tonight, you also get a one-to-one advisory session for yourself, where you can actually get strategic insights for your own business about what you should be looking at, what you should be focusing on, and also, basically how you can start building that strategic narrative for yourself as well. Now, the offer is only valid for tonight, right? So we'll basically, and I'll give you how you actually do that for a second. So to take advantage of the offer, we've also got another special offer, for tonight as well, right? Which finishes at midnight tonight, where this is where the crazy part, I promised at the start that I'd give you a ridiculous offer for coming along to the actual summit. So you actually get 12 months of access to Capital HQ and our investor ecosystem. So we've got over 25,000, in our Capital HQ ecosystem. So you get access to them for 12 months, whether it be for your own capital raising or your own sort of potential, for your own sort of strategic exit needs. It's valued at $5,250. You all would have seen us promote that. Also, you get you get lifetime access to our deal room software, which is normally valued at $2,495. So even after that 12 months, you can still utilize Capital HQ for all your capital related requirements, whether it be debt funding, capital raising, M&A, etc. Right? You can continue using it for the life of your business. You get access to all of Wholesale Investors conferences, whether it be locally or globally. So if we're doing events in Australia, you can come along for free. Whether we're doing events in Singapore, India, Dubai, etc., you're welcome to come along for free to that. And then also you get your own personalized onboarding session as well, just to assist you in setting up your deal room right, for when you do want to invite investors in, or when you do want to invite potential acquirers, etc. That all comes with tonight's special offer. The total value is additional value is $9,310. So not only do you save $500 on a ticket, but we're giving you an additional nearly $10,000 worth of value on top of that as well as part of coming along. So if you'd like to take advantage of that, if you'd like to join us at the summit, and all you need to do is you can just scan the QR code with your phone, right? It will take you through the registration process for it. Once you do that, you'll obviously have your tickets for the event. Now, as I said, we have done the tickets. If you're coming along, if there's two of you, and we really do encourage the two, to have two come along. If there's sort of two important people in your business, right? Because it's always good to go through this experience with someone else as well. You're effectively getting two tickets for the price of one, as well as the additional value that I've highlighted for the over $9,000 worth of value as well. So, and if you've got more than that you'd like to come along, then also you can save, for every ticket you get, you basically save $500 on those tickets. So the offer for that ends at midnight tonight. Now, as I mentioned, this is going to be the one and only time we actually do this event. As I said, it's been what, 7 months in the workings as far as organizing these together. It's actually much harder organizing this because of the quality of people we've got involved than it is our normal investment conferences that we do. And the best part is, it's a curated audience in that, high value people that are focused on ambition. So obviously there's incredible networking opportunities, whether it be for investment related, strategic related, or commercial opportunities as well. We're bringing a high caliber of people along. I'm also inviting my own shareholders along to the event as well, right, as part of it. So we want to do our best to make sure you have value. If you're an existing customer of Wholesale Investor as well, you do also have the opportunity to come along to the summit as part of your subscription as well. So if you're already a customer, you can come along to the summit, as part of your subscription. So, ladies and gentlemen, thank you for joining me. Apologies, I've gone sort of 10 minutes over. I hope you've sort of got value from the session. So my intention in doing this is I want people to start thinking about their business differently. I was very lucky to come across Tom McCaskill early. He was the one that set my mind in this direction. I've also, got some great advisors around me that are helping me. And it's funny enough, the high level thinking I found is also the most helpful. And then there's other people that can help you with all the technical aspects to it. But that high level strategic positioning and how you think about your business is important, because you could make decisions about your technology or how you collect data or how you think about data today that could impact your strategic value tomorrow. Right. And then but most importantly, you could understand what that strategic value could mean and what they could create from it. So I said, everything we're trying to do is help people think differently about how they build their businesses and how they think about it if they're going to go through their next capital raise or their next acquisition. So as I said, it's a special offer for tonight only. We'll be sending you an email shortly as well. So, either scan the QR now or click on the link when we send through the email, but take advantage of the offer. It's only available until midnight tonight, so make sure you take advantage of it. Ladies and gentlemen, if you've got any questions, feel free to ask now in the chat and I'll quickly answer them. I'm getting thank you messages coming through, which is nice. All right, ladies and gentlemen, well, what I'll do is I'll leave you to tonight. Enjoy your evening. As I said, make sure you take advantage of this offer. So we've worked incredibly hard to bring this to everyone and make it as an asset. I don't know when there'll be another room of this kind, where people can get access to these kind of people, this kind of information. I said, typically, the only way you find out about this is if you engage an investment banker and they're going to charge you $500K. And the simplest way I've thought about it is you're either going to spend 2 hours with a top M&A lawyer, or you can spend 2 days with the founders that have done it and built and scaled 8 and 9 figure businesses, the investors that actually back the companies that do it, and then the deal makers that actually guide the companies through that actual process. So it's to me, I think it's ridiculous value for what we're doing for everyone coming involved. So, ladies and gentlemen, enjoy your evening, and thank you for joining our session.